For our next conversation, Remastering the Universe, Blackstone's $80 trillion bet, please welcome interviewer Steve Forbes, Chairman and Editor-in-Chief, Forbes, and Jonathan Gray, President and COO, Blackstone.
Well, John, it's good to have you here. And as we discuss the fast-changing world and how you're taking advantage of it instead of deploring it, I have to begin, though, with a question. Given what happened to you in high school and basketball, where the junior year you were benched, even though the team lost 23 out of 24 games, are you going to buy a team?
Well, first of all, I deserve to be sitting on the bench, but that was a formative experience for me. But the short answer is no sports teams. I love watching sports, but I'm not going to be an owner.
Okay. So much for the teams thinking they're going to get a payday from you. Okay. But when you've been a lifetime, you joined in 1992 out of college. At the time, I think Blackstone was about $700 million. You've increased 1,500 times since then, over $1.1 trillion. And you have 230 companies you own, and you're huge in real estate. I didn't realize you have $100 billion in Europe of real estate. You have worldwide 12,000 properties with 1.1 billion square feet. And you were early in warehouses, which sounds retro, except you were at the forefront of e-commerce, the kind of properties you bought, which also gets to one of the things you do is that you don't always invest directly. You'll have one remove in terms of e-commerce, critical part of it, but it doesn't mean you have to plunge in the thing itself to benefit enormously from it. So the insights that we had on our cover is that, as you pointed out, there's about $80 trillion held by individuals around the world, $80 trillion, that's not really earning the returns they should. So even though private equity in the US is overdone now, overseas, it is still ripe. And that's one of the areas of opportunity there where we were about, 25, 30 years ago in some of these places. So I'd like to begin, before we get to the really innovative things you're doing in terms of buy-in and build, to walk us quickly through equity capital in the rest of the world, not here in the US, which is oversaturated, although you're doing very well, but the rest of the world, virgin territory.
Well, first, it's great to be here. Thanks for having me, Steve. You guys throw incredible conferences. I guess I'd start with the idea that when it comes to capital, historically it was in the liquid markets. And what we saw was people investing, just a small group of people investing in our world. It was pension funds, some sovereign wealth funds, endowments, and we didn't really see individual investors, insurance companies, and a bunch of other institutions. And that's particularly true outside of the United States, to your point. And I would say what's really developed, and we're on a journey, and one of the reasons our business has grown so much is because the addressable market has really grown. We've gone from doing just private equity, real estate private equity, distressed credit, really the highest returning strategies, over the last, particularly 10, 15 years after interest rates fell, into a bunch of other longer duration strategies. So core plus real estate, infrastructure, performing credit, both investment grade and non-investment grade. And that's opened up a whole new world. And particularly when it comes to individual investors, they're saying, hey, why don't I get what the institutions get? Why are pension funds 35% allocated to privates or alternatives and I'm not? And to your point, that phenomena exists in the United States for individuals, but it also does for people around the world who are even earlier on that journey. And then on the investing side of the business, yes, there's definitely much more capital in the private markets, committed to the US investing, less so in Europe and even less so in Asia, and further, even less in emerging markets. And so we think we're still in early days of the expansion of alternatives, and that's what gets us excited, even though we have grown so much.
One of the things, just hitting the U.S. for a sec, is you mentioned liquidity, which meant traditionally in equity, some would call it on a certain political spectrum, slash and burn, in and out, restructure, cut costs, and that's it. You've evolved a different approach where sounds paradoxical, but you sacrifice liquidity, but you get a higher return. Walk us through that insight, that you do better by being patient.
Yes. Look, I think there's been an evolution of the model in multiple ways. One is the traditional private equity business. Think of Richard Gere back in Pretty Woman in the 1980s.
Some of us are old enough to remember, yes.
And you're buying an old industrial business. There's huge cost takeout associated with that. And you're not thinking really about growing the top line. You're chopping up the business into little pieces. That really is sort of yesterday's story, because to generate outsized returns today, first of all, the leverage levels are much lower than they were back then. And the market has gotten much more sophisticated, particularly the public equity markets. They want to own growing companies. And so if you look at what we and a number of our competitors do in areas like life sciences or enterprise software or energy transition, what we did with Hilton Hotels to turn that business around, we're focusing on accelerating the growth in companies. Sometimes you might sell a non-core division, you may make a management team change, but you're really focused on how can I drive this company forward and grow it. And that's the way, when you look at the great deals of all time, Hilton probably the most.
Well, walk us through that, because you had just completed at the time, this was back in 2007, an extraordinary deal with Sam Zell, who was a huge empire. You unloaded most of the properties, except some good ones, before the market crashed. But you bought Hilton, and for a while it looked like it was a dog. And yet you didn't give it up, and in fact you invested money in a property that was losing value, at least in terms of value.
So I think Hilton's a good story, because for me it was incredibly formative. We bought for $26 billion this hotel business. We closed at the end of October of 2007. We had $20 billion of leverage. Let's just say it should have been a career-shortening moment. And pretty soon after we did the deal, of course, the global economy started going down. Cash flows at the company fell by 40%. We ended up having one of the employees of the company had taken some documents from a competitor, and so there was a government investigation that was underway. And I remember talking to Chris Nassetta, the then CEO, still the CEO today, and I said to him in March of '09 on a phone call, the good news, Chris, is it cannot get worse from here. We're at the bottom. And we ended up investing $800 million to help deleverage the company.
So you bought the depressed debt.
We bought some of the debt, but what we really did was, re-energize the company and grow it. Take Hilton Garden Inn and Hampton Inn and bring that around the world, move into emerging markets, bring a bunch of the brands to Europe, accelerate growth in the US. The hotel cycle turned. And what was so formative about that experience for me is, besides teaching you that you've got to sort of stay calm and keep your wits about you, but what it basically said is you should focus on the neighborhood where you invest capital and the quality of the business. And too often we'd been just, cash flow and model oriented. And what it led me to believe is we focus a lot on whether we pay 98 or 100 or 102, but if we buy something that's really great, in this case, in the global travel space, with amazing brands, with an asset-light franchising model, and you have the right management team, you can weather almost any storm. And that's led me and us, I think, to be much more thematic to some of these areas. Like you mentioned, global logistics, which is a huge derivative play on e-commerce. Having a belief, let's say, that India is going to be a long-term winner. Lean into some of these things, you have real excitement. So oftentimes, as you know, it's the things that go wrong or you get into trouble where you tend to learn more, and that was certainly the case with Hilton.
That's an interesting, management story in the sense that that's a cultural change. You have something that hits, instead of figuring out how do we get out of it quickly and with minimum loss, you actually, in effect, double down on it.
Yeah, and you often...
So how did you persuade yourself inside
look,
this was a make this kind of change?
I think in that case, you learn from experience. And ultimately, we had great experience owning this business, and it led to this more thematic approach. But also tying to your earlier question about longer hold periods is as we've evolved the business, we still run our drawdown funds, which we do mostly for big institutions, very successfully. But we also developed these perpetual vehicles, long duration, where you hold assets. And it can be with companies, it can be with infrastructure, it can be with real estate. And that does give you more of a family type ownership view of owning something for a long period of time. And if you fundamentally believe that what we can do is identify good assets in good sectors, put terrific management teams in place, and then figure out where to allocate capital and optimize the business, you should be able to do that on not only short-term holds or intermediate, but also long-term hold. So those tools apply, the ability to intervene and help companies can be done in a lot of different ways. And that does speak to the evolution of this alternative space. Again, it used to be much more, let's break things apart, short holds. Now it's how can we grow things, build things, and in many cases, hold for a longer period of time.
So you're credited with what you call perpetuals. Define perpetuals. You've sort of given some.
So a perpetual or open-ended vehicle is basically the idea you put capital in, you buy assets, could be credit, could be real estate, infrastructure, companies, and rather than saying, I'm going to, by the contract, sell the business after 5 years, return the capital, I'm instead going to invest and hold and get the benefit of compounding. A bit like a family, when it owns a really good business, it holds that business and allows the benefit of compounding, which is super powerful, as you know. And when you look on your Forbes 400 list, so often it's individuals who built businesses and then allowed that power of compounding. And that's what these perpetuals are. Tied to them is an idea that there's liquidity, but we call it semi-liquidity. If you think about a stock or bond, you can get liquidity generally every day. If you think about our drawdown funds, it's 10, 12 years before we promise to get you the money back. In these vehicles, we say we're going to give you your money back on a monthly or quarterly basis, but we're going to have a limitation on how much liquidity we provide because we don't want to be a forced seller of assets and hurt the people who didn't choose. So I think these structures have really resonated, but the most important thing, and it ties everything at our business and the industry, is we have to deliver for the underlying customers. If we don't deliver premium returns, then you should just buy liquid securities. You shouldn't invest with us. And so that's at the core of everything we do.
So in terms of, you talk about companies and liquidity, one of your insights was, why would a life insurance company be so interested in liquidity when they have 30-year obligations? Walk us through how you've now provided bonds, in effect, for companies like life insurers that yield 150 basis points more than the bonds that you would normally buy in a public market.
Well, if you think about credit, interestingly, to create a liquid security, there's a lot of cost involved with that. It's almost like a farmer getting his product to the market and selling it to a bunch of people along the way. If you're doing asset-backed financing for rail cars, or you're doing fund financing, a whole range of financings, if a bank originates, and banks are a critical part of the system, and the whole market's not going to move to private credit, but the bank's going to get paid fees for originating. They're going to bring in rating agencies. They'll do a securitization. There are costs associated with that. It's going to be marketed and sold broadly. And a bunch of the excess spread from the borrower to what ultimately makes it to the investor in those bonds is going to go to people along the way. So our pitch to our insurance company clients is, why don't you allow us to do what you've done traditionally, maybe in commercial mortgages, but in a broader range of credit assets, and we'll bring you up directly to that borrower who needs loan for his new pipeline project or new data center that's being built. You have given up the QSIP, it's no longer a bond, but you're capturing 150, 175 basis points of excess return. And since this is a 7-year security and your liabilities on average are 7 years, 20 years, 30 years, you can make that trade. And you're beginning to see that in the insurance industry, just like we talked in private wealth, you're beginning to see the migration into alternatives from a very low base. You're beginning to see the same thing in insurance. And again, that opens up a new market. But the irony is you think of us as the high returning asset class, and yet we have amongst the lowest cost of capital today when we're managing.
Again, seeming paradox. You being supposedly high risk business, you are lending to, your rating is better than the A rating, the double A. Imagine an equity fund that has a very high rating and doing A and double A lending, which seems preposterous.
Yes, but if you think about if you have a credit business and you'd specialize in riskier credits, right? You know, if you're an expert in junk bonds, could you not move into investment grade? Similarly, if you also have expertise in different asset classes like infrastructure, which needs an enormous amount of capital today, if you know that on the equity side, shouldn't that make you a better credit investor? And so what we're really doing is bringing the benefit of private capital to all different underlying borrowers, being a full service capital solution provider. And if you think about it from the borrower's standpoint, oftentimes financial institutions will say, the price is what the market brings you, so you don't necessarily know what the price of the borrowing is. In this case with us, we'll say, since we're in the storage business for our insurance companies, the price is $225 over. And so I think this is a powerful change. And then from a health of the financial system, because we're generally doing this as an investment manager on an unleveraged basis or lowly leveraged basis as it relates to non-investment grade credit, or on behalf of our insurance companies who have long duration liabilities, I think it's also strengthening the financial system at the same time.
Well, in a way, the whole rise of what they call junk bonds opened up debt to companies that normally wouldn't get it. You've created a revolution here, and that gets to what you might call private credit or non-bank credit. Banks, this is me talking, not him. I think the regulations are almost designed to make banks conduits to buy government bonds instead of lending. But you're now in the lending business in a major way. Banks may complain about it, but your company's changed. You're a non-bank bank and provide loans. Plus, he has $200 billion, just to let you know, of a war chest. So if you need a project, he's the guy to go to. But seriously, on non-bank credit, this is a nascent market, would seem, that's going to be where equity funding was 30 years ago. It's going to take over the world.
I don't know if it'll take over the world, but I think it'll give more access to capital to consumers and businesses. So today we're managing over $400 billion in our credit business. And you said, you know, we're a non-bank bank. Interestingly, we don't take any deposits, and we're just an investment manager. So one of the challenges for banks, of course, is their business model involves being levered 12 to 14 times. And the fundamental mismatch, right, of short-term deposits and long-term assets. Now, as I keep saying, we have to have banks. We've got to have the vital role they play. But to complement that role with private capital, and in many cases, we're partnering now with banks, where if you think about it, they may make a long-duration loan. Think about First Republic failing, not because there were any problems in their loan book, their super prime mortgage book, it was because of the mismatch of duration. So if we can help place those loans in long-term hands, again, that's better for the system, but it does speak to the broadening of things we do.
So in terms of liquidity, a lot of entities today suddenly find they have assets, they suddenly need cash, like endowments did 15 years ago, when suddenly they find that these investments weren't very liquid. You're in the market to buy those assets.
We're in the market to buy things. I think one of the great areas today to deploy capital are spaces where people need liquidity. So we have a secondaries business that buys interest in funds. We've got hybrid capital, tactical opportunities.
So you're almost a lender of last resort, and you're not even a central bank.
Yeah, but you can be a high octane lender, you can be an investment grade lender, you can be a control equity, you can be a minority equity. What we're trying to do is take the insights we see around the globe and share that in our different lines of business. And that's really the connective tissue.
And going to just hit real estate, commercial, we all know what happened to the commercial market. you did things differently. But let me ask you a broad question. Commercial real estate, is the worst over like Hilton was in 2009, or are things more bad news to come? Is this a time to start looking at the rubble and saying there may be some gems here?
I would say both. Yes, the worst of the storm has definitely passed in commercial real estate. But the wreckage still takes time to work its way through the system. And this is the moment when you want to be deploying capital, sort of jumping back into the pool. If you go back to 2009, after the financial crisis, you wanted to invest then, but there were bad stories about commercial real estate deals from 05 to 07 running through the system for the next 3 years. And as investors, you're trying to separate what happened in the past, the wreckage, with the future. So if you think about it this way, what happened in commercial real estate the last few years? Office buildings badly hurt by COVID and a sharp reduction in demand. And interest rates went up pretty dramatically, which hit yields, cap rates, multiples came down. Both of those things have happened. If you go out to sell an apartment complex or an office complex, it reflects the new world today. What that means is you want to invest, and you see us doing some very large things, buying distressed loans, privatizing rental housing companies, buying a bunch of logistics in Europe. What you will still see is loans that were made in an earlier period, a bank taking a write down, that bank may getting hit, or an open-ended fund writing down an asset to the current market price, and then the press will say real estate's still declining. Again, think about it like the storm and the wreckage. The wreckage takes a long time to work its way through the system. The storm has passed. What we're seeing today is base rates have started to come down. The 10-year's come down. The Fed's going to start cutting rates here soon, given what's happening in inflation. Spreads in commercial real estate borrowing have tightened. The CMBS market's reopened. And you're not building much because cost of capital is high and people are nervous about real estate. All of that starts to build the foundation for the recovery. And so this is where you say you want to invest before that all clear side.
One of the things you do with your 230 companies is try to coax them into AI.
Yes. Well, look, that AI, which I'm sure has been a topic here in a lot of the different panels, is fascinating because the scale at which it's going to impact our lives, our businesses. I'd say what we've tried to do is multiple things. One is play AI. You talked about not necessarily doing it directly, but derivatively. And so if you think about AI, the physical manifestation is the data center. So we own across our portfolio companies, either existing or under construction, $50 billion. And we have another $50 billion of data centers in various stages of development. This is driven by the demand from the major tech companies. And so that's one way to play this. Obviously, there are other businesses that are benefiting, contractors. We did a big $7.5 billion loan for a data center cloud company. We're trying to find all these derivative plays. And then at our portfolio companies, we've been using predictive AI, which is basically numbers in, numbers out for a long time. We have a large data scientist team with 50 plus people who help companies think about pricing and staffing and so forth. And I think we, like everybody else, are trying to figure out how to use generative AI, to how to use the images, the sounds. And so we own a company, Ancestry.com, the family history business. Imagine typing in your name and not just seeing a two-dimensional thing, but some sort of movie-created sound and all sorts of the newspapers of that day, and the whole thing pulled together quickly. Think about the tools for software and other media businesses. So I would say for us, like everybody, we're moving quickly to try to figure it out, but there's a long way to go. The predictive stuff was much easier. We're trying to make the use case across our companies with generative AI.
We're running out of time, so I want to do a quick tour of the world.
Okay.
You are making a huge investment in India.
Yeah.
You know the raps about it, too bureaucratic, infrastructure sucked, and the recent elections where the far left made huge gains. Yet in the next 3 years, you're in effect doubling down your investment in India. Quickly walk us through why you think this is a fantastic opportunity.
I just think the country is in a very early stage of its growth. Its GDP per capita is a fifth of China. It has a very pro-growth government who may not have as big a margin, but will still be running this country for the next 5 years. They've done a bunch of things to build new infrastructure, both physical infrastructure and improve their capital markets infrastructure. They've loosened up all sorts of rules to allow foreign ownership. We've had incredible success in both real estate and private equity, playing the rise of the consumer there. Their export economy is growing, both of services and goods. The pivot, as companies look to diversify where they manufacture, India is a winner in that. You've got 400 million people who speak English. I think it's a very interesting place. Obviously, you have to know what you're doing there.
Closing, we could cover the world, but quickly hit Japan, which on paper, they have national debt twice our own. They're still suppressing interest rates. 10 years yield, what, 1%? Yeah. Yet you're making big bets in Japan.
Yeah, I was just in Japan a week ago. What I'd say about Japan is, again, there the government has really focused on getting that economy sort of a rebirth of dynamism, pushing companies to think about return on equity, getting inflation to come back, which is hard to believe here, something you would do, has really been beneficial, because if you think about living in a deflationary world, you have no incentive really to take risk. You get a positive real return leaving your money under your pillow. Thereby getting inflation, you're getting individuals to go from being savers to investors. Companies now have to pay higher wages. They have to think about being investors and being dynamic. So I think Japan is in a good place. It's got some long-term demographic challenges, but it's beginning to sell off businesses, things we did 30, 40 years ago, which creates opportunity, and there's an openness to private capital. So yes, there's a big world out there.
In closing on Japan, the number's amazing. They have $13 trillion of assets, financial, including $5 trillion in cash and almost non-yielding assets. Prime opportunity. Well, John, thank you very much, and you've got a great future.
Thank you. Thanks, everybody.